Hi everybody. I wanted to take some time to talk to you about our midterm that is going to be coming up and also go over the practice midterm with you. So if you had any questions about any of those items in there, you can refer back to this video to see how I would suggest working some of those practice midterm questions. By now you probably had some time to work with that a little bit, so I think it's okay now for us to go ahead and let me give you some tips on how to answer some of those, because the practice midterm is going to be very similar to what you will see on your actual midterm coming up here in the next few days. So I want you to take a look, though, before we do that, at your news forum and go to the midterm 1 message. You may have seen this already, okay? But midterm 1 is going to cover chapters 10 through 13, okay, as you've seen on the syllabus. The exam will consist of 20 multiple choice questions. It'll be worth 4 points each, and then 1 full-blown problem. Again, I would refer you back to your practice midterms to see examples of the type of questions you're going to see, because that is very indicative of what you'll see on the actual exam. The midterm will be given here in e-learning under the midterm 1 module. So you'll see it right under our practice midterm week. Then you'll see practice midterm 1 there. You go in there and you'll see the quiz being posted there, and you will have to click on that to open that. Okay, now the exam will be available for you starting at 12 a.m. on February 14th, 2021, and it will close at 11:59 on Saturday, February 20th, 2021. So you get the full week to work the exam. Now that doesn't mean I just leave it hanging there open for the full week. You have to take the exam during that window. Okay, it'll be available for you during that window, and you have to take it during that window. I don't accept excuses. I get students that like to wait up till the last minute, and then they get confused and they can't open it, and all kinds of different weird things happen. So give yourself appropriate time. I'd say maybe Thursday, maybe Friday towards the end of the week. Go ahead, open that exam. You'll get 3 hours to work it once you open it. Now don't click on it until you're ready to start. If you click on it, sometimes the students think, oh, okay, I'm just going to look at the exam first, then go study, and then come back and take it. No, it doesn't work that way. Just like a regular exam, once you open it, the clock starts running on you, and you'll get 3 hours to work that exam during that window. Okay, so make sure you do that you give yourself a full 3 hours, because it closes automatically. So you must start the exam no later than 3 hours before the close in order to receive the full 3 hours. So the latest you would start the exam would be 9 p.m. on Saturday night. Don't do that. Pick a day that's available for you where you can, be undistracted, get the full 3 hours to work those questions. Okay. You can use any material that I have provided here in e-learning, and you can use your textbook material to help you, with the exam, during the exam. If you want to refer to something I've given you, that's fine, okay? Only materials from this class. I don't want students start going to different, illegally acquired, if you acquire a test bank from one of these sites, you are in violation of the law. And if you do that, you're going to get a 0. Okay, so don't do that. Don't get those things. Just stay away from those sites. Do your own work. Don't reach out to other students. And I have data analytics that I look at that I can see if someone has cheated, and it is not a pleasant experience. Okay, so just do your own work. You've been prepping for this. We've been going along, building up chapter by chapter. We've had the practice midterm. There's no reason you shouldn't be able to do fine on this exam doing your own work. Okay? Okay, good. Those are the key things that I wanted to go over in that message. Okay, you can read that on your own as well if you haven't already. So what I want to do now is go back. I don't know why I came out of there. And I want to go and look at this practice midterm. Okay, so we're in practice midterm week. I'm going to go through this with you. Next week, week 6, you'll have a module right here. That's where your midterm will be. I think it's labeled as a quiz, but that's your midterm. Okay, e-learning labels that as a quiz for some reason. Okay, all right, good. So let's go ahead and when we click on that, I've already opened it because if I open it while I'm recording, something bad always seems to happen. And let's go ahead and take a look at some of these questions. Again, we're looking at questions from chapter 10 through chapter 13 in this particular practice midterm, right? And that's what will be the material. That's where I'll pull the material for your exam from. So on January 1st or January 2nd, 2020, January 1st, January 2nd, I don't know why they say January 2nd. It's just as though it was on January 1st, okay? Your corporation replaced a boiler with a more efficient one. The following information was available: purchase price of the new boiler, etc. The old boiler was sold for $4,000. What amount should your capitalize as the cost of the new boiler? Now, you got to be careful because in chapter 10 we talked about non-monetary transactions, and that's probably one of the more difficult areas that we'll be looking at, or that we've looked at, and we'll see a couple examples of questions in your practice midterm coming up, in this practice midterm questions coming up. But this is not one of those questions, okay? So your brain automatically starts thinking, oh, non-monetary transaction. No, this is, I acquired a new asset for cash apparently, and then I sold an old asset for cash, okay? So you don't have to worry about those non-monetary transaction rules. All we're doing here is we're trying to figure out what we should record as the value of the new boiler. That's what the question says, okay? Capitalizes cost of the new boiler. So of course, we're going to pick up that $150,000. That's the purchase price. We know we have to capitalize that. Carrying amount of the old boiler is irrelevant here. It has nothing to do with the value of what we're going to bring on that new boiler, because we bought this one for cash, we're putting it in, we're selling the old one. It is not an exchange of non-monetary assets here. So the carrying amount of the old boiler, irrelevant. Fair value of the old boiler, again, irrelevant for what we're going to be dealing with for the new boiler. Installation cost of the new boiler, yeah, you bet you. Anything you have to pay to get an asset into your place of business so you can use it, like installation, delivery fees, that sort of thing, is all part of the cost of that asset. Answer A, $170,000. Okay? All right, so the most important thing there was just tuning out other things that you're still, firming up in your mind and stuff. That's why it's important that you practice so that you get used to looking at problems, picking out the relevant information. They gave us a bunch of stuff we don't need here in this particular question. Okay? Okay, good. Number 2, on September 10th, 2020, Jenkins Company incurred the following costs for one of its printing presses. Neither the attached nor the renovation increased the estimated useful life of the press. However, the renovation resulted in successfully increasing productivity. What amount of cost should be capitalized? So if we increase the productivity of an asset, we're going to capitalize that to the asset account. If they had told us that it increased the life, then instead of debiting the asset account, we would have debited the accumulated depreciation. We don't need to worry about that here because they're asking us how much should be capitalized, so they helped us out by, they did have 0 as an answer, so it's important that they told us should be capitalized, not debited to accumulated depreciation here. And so let's go ahead and take a look at what should we add to the asset account now for these things that we've bought to renovate this printing press. Okay, so how about the purchase of the equipment? Yeah, right, we're going to go ahead and we're going to purchase the equipment, $55,000. Installation of the attachment, yeah, we're going to output checks instead. Okay, We're going to what? We're going to pick up the installation of this attachment, replacement parts for the renovation. Yeah, okay, we've got to capitalize that. We need that to get this new asset going, and labor and overhead in connection with the renovation. Well, I like a problem like that. Unlike this one up here, we had to ignore a bunch of information. This one, what? We don't ignore any of it. We use every bit of it, and we would capitalize $85,000 and credit accounts payable, cash, whatever we're having to credit for the cost of incurring these different pieces to this renovation. Okay? Okay, good. That's pretty straightforward. Let's take a look now at this number 3. Okay, and they tell us that Huff Company exchanged non-monetary assets. Okay, now look, if it's non-monetary assets, okay, just to sort of visualize this up here, we know that it's going to be, and I don't know what the equipment is in this example, I'm putting wheels on it for some reason, okay? We know that we're going to have 2 pieces of equipment, okay? We're going to have one company that is going to have their equipment. We have another company that's going to have their equipment, okay? And I'm using H&S because the 2 companies are Huff and Sailor here, and they're what? Exchanging equipment for equipment. There may be some cash involved in that, but the fact that they have called this non-monetary assets, meaning cash is not going to constitute a major part of this transaction, and we're going to have to use our non-monetary transaction rules. Okay, so we come over, and Huff Company, there's Huff, exchanged non-monetary asset with Sailor Company. No cash was exchanged, and the exchange has no commercial substance. Okay, so if it's no commercial substance, what happens? No commercial substance, the rule is we always recognize losses. No commercial substance, we will what? We will only recognize gain to the extent that there is some cash involved in this transaction. And we looked and they told us there's no cash. So we're not going to be recording any gains here. We will record losses. We always record losses. Now they tell me that the carrying amount of the asset surrendered by Huff exceeded both fair value of the asset received and Sailor's carrying amount of that asset. Huff should recognize the difference between the carrying amount of the asset it surrendered and they go, and now they're asking us about gains and losses. Now look, you know that there's not that you're going to have to look at this, and because it's a non-monetary transaction, you know that there's not going to be any gains. Okay, so when you look at this, you right away can go ahead and get rid of B and D right out of the gate. Okay, so the question is how you're going to calculate that loss. And if it's a loss, right, if it's a loss, that means that the book value of this asset, right, is greater than the fair market value of this asset for Huff. Okay, so the loss is going to be to what extent does the book value exceed the fair market value. Okay, so you look and they say that Huff should recognize the difference between carrying value, book value, guys, I think you know by now are synonymous, of the asset surrendered, and what? And the fair value of the asset it received is a loss? Yeah, that's the case. That's going to be the loss because they tell us in the problem that the book value is more than the fair market value. We really didn't need to look at that because we know that there's no gains in a non-commercial transaction lacking commercial substance, and it's all about what it's being carrying on Huff's books. What it's being carried on in Sailor's books is of no consequence. Okay? Okay, good. Okay, so let's go ahead and let's take a look at this question number 4. Colt Company had a player contract with Watts that is recorded in its books at $8,400,000 on July 1st, 2020. Day Football had a player contract with Kurtz that is recorded in its books at $10,500,000 on July 1st, 2020. On this date, Colt traded Watts today for Kurtz and paid a cash difference of $1,050,000. The fair value of the Kurtz contract was $12,600,000 on the exchange date. The exchange had no commercial substance. Okay, so now we start seeing some information that's, giving us a clue where we're going with this. The exchange has no commercial substance. And after the exchange, the Kurtz contract should be recorded on Colt's books. Now, maybe I should apologize a little bit for a question like this, because it's kind of hard when you're dealing with an abstract of a question. Okay, so you got Colt is one football team over here, and they have this contract with with this Watts, okay, who's a player, and then it's going to go over to Day, and Day has what? Day has this player, Kurtz, okay, and so Kurtz, I guess, is going to go to Colt, and Watts is going to go to Day, and they want to figure out what we should record this Kurtz contract, assuming the transaction has no commercial substance, on Colt's books. So we're going to be doing Colt's accounting here, okay? And then it helps to stop and think about, well, what are the rules here? If it's a non-commercial substance, no commercial substance transaction, then we're going to bring the new asset, in this case, this Kurtz contract, onto Colt's book at what? At the book value of the assets surrendered, okay, minus any loss, or potentially plus any gain, because cash is involved in this transaction. But since Kurtz is doing what? Kurtz is paying the cash, not Kurtz, excuse me, since Colt, the one we're doing the contract for here, the one we're doing the accounting for here, is paying the cash, well, they will only recognize a gain if the cash constitutes 25% or more of the total consideration, right? Okay, so first, let's see if we can figure out the book value of any assets that were surrendered by Colt. And Colt did what? Colt surrendered a contract with Watts, it's just kind of hard to keep track of all these names here, for $8,400,000. Okay, and it was recorded on its books for $8,400,000. They tell us Day's contract with Kurtz, what it was recorded on their books, which is not really relevant here because we're not doing any of Day's accounting. We're doing Colt's accounting. The fair value of the Kurtz contract, $10,500,000 on July 1st. Colts traded Watts today for Kurtz and paid cash of $1,050,000. So there we go. Kurtz gave up the contract that had a book value of $8,400. They gave up cash of $1,050,000. Okay, and I start looking, and I'm now, no pun intended, in the ballpark of the answers here right now. But I'm not going to just jump to A, because I have to see, well, is there a loss? Is there a gain to Colts here? And if it's a gain, I will take the entire gain if the cash constitutes 25% or more of the total consideration. So I start looking here, and I'm like, well, okay, it has a book value of $8,400, but what's the fair value of the contract? Well, look, if the Kurtz contract has a fair value of $12,600,000, okay, and to get that asset, that contract that has a fair value of $12,600, I have to give up a contract that has a fair value of this. I have to give up along with my player's contract, I have to give up $1,050,000. That is in effect saying if you take off $1,050,000 off of the 12.6, the fair value of the contract that I'm getting here, that difference, I always forget to do my math beforehand. I set up the math and then I don't do the math. 12,600, okay, minus 105,000 gives me 11,550,000. So if they're saying, look, we got this great player, Kurt, he's got a fair value of 12.6, give us Watts over there and 1,050,000 and we'll call it even. Well, that's a tantamount to telling you that they think Watts' contract is worth 11,550,000. So if you look at the difference between the book value of the Watts contract and the implied fair value, because you got another player that's worth 12.6, but you had to cough up some cash too, you're saying that contract was worth 11.5. There's a potential gain there. But should I recognize that gain? Well, the cash constitutes 1,050,000, right? That's the boot, right? And then the fair value of everything that's being exchanged is 12.6. I know that because they told me, well, 12.6 is the value and you had to give up 1,050 of cash. 1,050 plus 1,150, we can see right here, equals 12,600,000. So if I take 1,050,000, okay, and I divide that by 12.6, that one I did do the calculation on, that only comes to 8%, 0.08 give or take. And so I'm under the 25% threshold, and since I'm paying the gain, paying the cash, I don't take any gain. So that means there's no gain involved in this, and so the value of the new contract is just going to be straight the book value of the asset surrendered, 9,450,000. Okay? All right, now what made that question difficult, guys, is all those names in there. I'll try to stay away from a question that's got 52 names. I think it's better if you're just dealing with, you know, machine A, machine B, and the two companies as opposed to Waltz, Cole, Dave, Kurtz. You know, it gets a little bit weird. I'm not here to challenge your mind in that manner, okay? But if you get stuck, it doesn't hurt to draw yourself a little diagram too, okay? All right, good. Okay, so let's come over answers A on that one. Let's take a look at number 5. And a company is constructing an asset for its own use. Construction began in 2020. The asset is being financed entirely with a specific new borrowing. Construction expenditures were made for 20 and 21. At the end of each quarter, the total amount of interest costs capitalized in 2020 should be determined by applying the interest rate on the specific new borrowing to, okay, capitalization of construction period interest. What were the rules? We have to be making expenditures for the construction. They were. Okay, in that question, they were making the expenditures for the construction. We have to apply an interest rate to something called the weighted average of accumulated expenditures. And so the interest rate that we will apply will be the interest for the specific new borrowing. And that's the amount that we will capitalize as long as construction is continuing on. In the event that we have what? We have weighted average of accumulated expenditures that are in excess of the specific new borrowing, then we'll have to calculate an average interest rate on all other borrowings of the company. Okay, those were the major rules in that case. Well, all they're asking me is what should I apply the interest rate from the specific new borrowing on? And the answer is what? The weighted average of accumulated expenditures for while the construction is going on, 2020 and 2021. Okay? Okay, good. Let's take a look at this. And here we come with another transaction, and what should we do when the transaction lacks commercial substance. So we're getting a lot of batting practice with that. With this topic here, that should give you a clue as to what you're probably going to be seeing on your exam. Don't think that I'm not going to ask you that, okay? All right, good. So we come over and we have this Hoyle Company, traded machinery, with a book value of $60,000 and a fair value of $20,000. And they should say, what amount should the gain or loss stop? If there's a loss, I take the entire loss. That's it. And the loss is the difference between what? Between the book value and the fair value. Fair value is less than the book value. So I have what? I have a $40,000 loss here. Okay. So be careful too. Some of these problems, they give you everything you need to answer it in the first sentence, intending you to kind of get a little bit tangled up in some of the, bunch of information that comes in after that. Meanwhile, you've got the information you need to be able to answer that question in the first sentence practically. Okay? Okay, good. So let's go ahead and let's go over to this number 7. And I did get an email from a couple of you saying, I don't understand number 7. 7 isn't hard, but you got to kind of keep track of what you're doing as you go through and follow through what the requirements are that we've talked about back in whatever chapter, was it 10 when we talked about this? Okay, so they come in and they give us all this information and they want to know avoidable interest, okay? Now, the trick there, avoidable interest, is the amount to capitalize. Okay, the amount to capitalize. They call that avoidable interest. You can capitalize it if the sense is that you wouldn't have incurred this interest cost, but for the construction. Okay, so that's why we say, hey, construction has to be going on. You have to be incurring interest, etc. Okay, so it's because you were involved in this construction that you're incurring this interest. Now, this transaction or this question has a few layers to it, and so I'm looking now and saying, okay, John, you need more room. Okay, it's the first thing I realized when I worked this. Not a bad idea to have yourself some scratch paper when you're going through these. Okay, amount to capitalize is what we mean by avoidable interest. Okay, and I'm going to co-op all this room up here, guys, and I will post this marked up version assuming Word allows me to, but I'm going to kind of be writing all over this thing. Let me clear up some space here so I can sort of show you the steps. It's like I said, it's not difficult, but there's some things you have to do. Now, the first thing I want to do is try to figure out, well, what is my weighted average of accumulated expenditure here? And they tell me that Arlington Company is constructing a building. Construction began January 1st and was completed on December 31st. Expenditures were $6,400,000 on March 1st. So I know I have to pick that up. $6,400,000. And since they spent that money on March 1st, that money was outstanding all of March, April, May, June, July, August, September, October, November, December. That's 10 months, okay? So I go ahead, and the reason I count on my fingers, guys, is that it is easy to see March and make the mistake, which I did when I first did this calculation. I did it 9/12. It's 10/12, okay? Because you did it March 1st. So make sure you're counting the months. If you're not using your fingers, count it off in your head like that, okay? So when I do the math on that, that becomes 5,333,000, comma, isn't this exciting? Okay, and 33 cents. Okay, all right, good. Then they tell me that they spent $5,280,000 on June 1st. So I got to pick that up. $5,280,000 $380,000. And I need to multiply that by 7/12. Okay, now again, it's easy to make the mistake. Oh, June, that's 6 months. And I'm sure the choices will feed into that mistake, okay? No, it's 7 months because you count June, right? And since it was June 1st. And so when you go ahead and you do that calculation, 3,080,000, I guess that comes out evenly, I don't know. Okay, and then they tell me on December 31st, they spent $8 million. I don't care. That was not outstanding any part of the year. So I don't do a calculation for my weighted average accumulated expenditures for amounts that were not outstanding any fraction of the year because they didn't make that payment until December, right? So I go ahead and I add these two up and I get 8,413,000. 33333. Okay. Okay, good. So I got my weighted average of accumulated expenditures. Now I have to apply an interest rate to that, and I apply an interest rate to this from the specific borrowing. So they tell me that they borrowed $3.2 million on January 1st at 12%. Now, I've got a little bit of a problem here, or I've got to be a little bit careful here, because I know that I can apply the interest rate to the specific new borrowing, $3,200,000, and I know the interest rate they told me is 12%. So that's going to give me, what, if I'm doing my math right, please God, $384,000. But I'm stopped there on that 12% because the interest rate was for that amount. What amount should I capitalize on this additional weighted average of accumulated expenditure? So I take the $3,200,000, right, 0.00, $3,200,000. I subtract that off of the $8,413,000, and when I do, I get this number. And guys, I'm going to just pull the number down here so it's easier to see. Okay, the difference between those two numbers, okay, is going to be $5,213,324, okay, and 23 cents. Okay, now I have to apply an interest rate to that, and the interest rate that you apply to that is the interest on all other borrowings of the company. Well, they tell me that they borrowed what? 6.4, okay, at 10% interest, and they tell me that they borrowed what? An additional $12 million at 11% interest. So what's the average interest on those other borrowings? And so now I come over, let's see where I want to write this, okay? Now I come over and I say, well, look, how do I want to do, where do I want to write this, okay? 6 million, I'll do it right here, 6,400,000, right, times the 10% interest rate associated with that is 640,000, okay? 12 million, that amount here, right, times 11% interest is 1,320,000. Okay, now when you add those two amounts up, that becomes 1,960,000. Okay, that's the total interest on that. And so you take what? 1,960,000, and you divide that by the total that was borrowed, 6,400,000 plus 12 million Okay, and when you do the math on that, you get 1 million. The interest on this 1 million, this number here, 1,960,000 divided by this total here, which is what, 18,400,000. Okay, that gives you now an interest rate of roughly 10.652 is the average interest on all the other borrowing. So when I sit here and I multiply 0.10652 times the amount of weighted average of accumulated expenditure in excess of the specific new borrowing, which was a 3.2, I get this number here of 5. Where did I write that number, John? Where's that number? Number, please. 555. Okay. 323. Okay, and when you add now the amount that I capitalized from the borrowing plus the amount for the specific borrowing, the excess weighted average accumulated expenditure using the average interest rate for all other borrowing, I get 939,323, and then I pray that that is a choice. And yeah, that's choice D. Okay, give or take $3. Guys, I'm not going to sit here and have answers within 2 cents of each other. Clearly, D is the correct answer. Okay? Okay, good. That's a lot of steps. But I think if you, kind of keep your wits about you and go through that and methodically do it, that's probably not that difficult of a question conceptually for you. Okay? Okay, let's go ahead and take a look at this number 8 now. And basically, we've got a mining question here, so we're going to have to use our depletion accounting, okay? So we've got this Mallory Mine Company, purchased a mine for $8 million, removable coal, etc. And, it's probably worth it to peek down. You don't have to do it this way. You're going to have plenty of time on your exam. So you maybe would read through the whole question and then read it again. But if you were trying to save time for some reason, you might jump down and look and say, okay, they want the total amount of depletion. So the rules are I'm going to have to figure out what cost should be included for the mine, divide that by the amount of whatever it is they think they can take out of this, I guess coal in this case. That's going to give me an amount per ton, probably. Okay, whatever it is, amount per whatever the way they're quoting the total amount of stuff that's in that mine. And then to figure out the depletion, I'll take the amount that they took out for the period times that rate. Okay, all right, so that's basically the rules here. So we come over and we say, okay, they purchased the mine for $8 million. Okay, so part of the trick is to know what you have to put in there, obviously what they paid for it. Removable coal is estimated 1.5 million tons. Now, I'm not ready for that yet, but just so I don't have to go back up into the question, I might write that down on the side so I know that I'm going to use that in a minute. Okay, now they're required to restore the land at an estimated cost of $960,000, and I'll avoid my speech there about how I think it's ridiculous that companies ignore that. They don't save the money they need to do that, and then they go to the government at the end of the contract and say, we don't have the money to clean it up. Well, why weren't you depositing an amount every year or so to make sure you had the money that you need to clean up this mess after you take all the coal out of the ground? I said I would make the speech, and then I did. Okay, so $960,000 is what they're going to have to pay to restore the land, and the land should have a value of $840. That's the only thing that makes me mad. It's not like they take the land from you after you restore it. It's still your land, and then you could sell it off. So there's really a net cost associated with cleaning it up. Stop. Okay, I'm talking to myself. Stop, John. The company incurred what? $2 million of development cost. Okay, that's pretty common. You know, you're going to have to build mining shafts and stuff so people could go under the ground to get coal so they can get black lung disease. And then during 2020, 360,000 tons were removed. Oh, okay. Let me write that down. They removed 360 and 240 were sold. Okay. Now, I'm going to take all of these costs, add them up, and, you know, subtract that 840. That's a subtract. But after I do that, I get 10,120,000. I divide that by 1,500,000. Okay, when I divide it by 1,500,000, I get $6.75 per ton. Okay, now this asks the total amount of depletion. Well, the total amount of depletion is based on what I actually took out. So since I took out the 360,000 tons times the 675, that gives me 2,428,000, okay, as the correct answer to this question. Now, you say, well, why did they tell me the 240,000 tons were sold? My first answer is I don't know, because you didn't need that for this question. Now, if they had asked me, so I think they were just trying to distract you. Now, if they had asked me what is the cost of goods sold, or sometimes they call it depletion expense, which I disagree with them. If I'm preparing a multiple step income statement, you generally have sales minus the cost of sales or cost of goods sold, whatever, to calculate a gross profit number, because analysts are very interested in gross profit. So most companies would report a gross profit number and treat this 240,000 times the 675 per ton as a cost of goods sold, not an expense. But you do see some questions where they call it expense. The difference between the 360 and the 240 is 120,000 times the 675 is going to be the inventory. But if they just ask you total depletion, the total depletion is everything you took out for the period. Some of it is sold, some of it is going to hit the income statement in the form of, again, they call it expense sometimes. I think it probably more appropriately be called cost of sales, cost of goods sold. Okay, good. Let's go ahead. That one's not too bad. Okay, let's start to take a look at some potential depreciation questions. Okay, and when you look at this question now with the depreciation, notice they're telling us straight line. Okay, now look, I might ask you just a quick, easy straight line question, but you're getting past that stage in the development of your understanding of accounting and whatnot. So it's more likely that I'm going to use straight line in combination with some other factor, like asking you to calculate the gain or loss on the sale, or maybe saying, hey, they depreciated the asset up to a certain point and then they did some repairs, which would be the depreciation going forward, which is what I think this question did. Okay, so Glow Company purchased a machine in January 1st, 2015 for $880,000. They're using the straight line method. The useful life is estimated to be 10 years, salvage value of $80,000. Okay, at the beginning of 2021, Glow spent $192,000 to overhaul the machine. After the overhaul, Glow estimated the useful life would be extended 4 years, which give it 14 years total, and the salvage would be $40,000. The depreciation expense for 2021 would be, okay, well, we got a lot going on here because we bought this machine in 2015 for $880,000, okay, and it had a salvage value of what? $80,000, okay, and so 880,000 minus 80,000, I guess even I can do that one in my head, is 800,000, okay, and they said that it was 10 years. So you take 800,000, you divide it by 10 years, that means they were depreciating this machine at 80,000 per year. Okay, so let's go ahead. Now we have this 80,000 a year depreciation times the, times the 6 years now that they would have depreciated this, 2015, 16, 17, 18, 19, 20. Yeah, I've got 6 years before they made the repairs. That comes out to what? 480,000. Okay, so I take that 480,000, I subtract it off of the original cost. So that means that that machinery at the start of 2021, before I started doing all these repairs, or not repairs, but overhaul, okay, that's 400,000. Okay, if it's a repair, you expense it, right? Overhaul, major repair, we're going to have to capitalize. So we take that 400,000, and they tell us that they spent what? They spent 192. Okay, so that means that I'm going to have to now depreciate over the remaining useful life 592,000. Right? Okay, but then I sit there and I say, well, how much time is left on this thing? Well, before I do that, and they tell me the salvage value is 40,000. So let's just finish that. So if I subtract 40,000 from 592,000, I am now left with 552,000. I'll write it over here. So now I just have to figure out how much time is left on this thing. Well, what happens? How would I do that? Well, they tell me it's a 10-year life. So I'm just going to write that here. 10 years. We depreciated it what? 6 years before anything happened this new year where we started doing the work on it. So this thing has what? 4 years that was left at the beginning of 2020, and they tell me that the repairs extended the life what? Extended the life 4 more years. Okay, so if you take 4 plus 4, that gives me what? That gives me 8 years. And so now I take that, what, 552, I divide it by the 8 years that are left, and that should give me the right answer here of what, 69,000? That's taken as the depreciation in 2021. And then I would just go forward the rest of the life with that. Okay? Okay, good. Let's take a look at King Corporation. Okay? And we're talking about potential loss on impairment here. Again, I'm jumping down to what they want. You probably would want to read the question more carefully, obviously, if you're taking this. But if I'm looking for a loss on impairment, the rule is what? I take a loss. It's a two-step process for a fixed asset. So I'm going to sit here and I'm going to say, well, let me make sure I've got this. If it is, if the present value, well, I'll get it right, guys. If the what? If the cash flows exceed the book value, no impairment, I stop right there. If what? If the fair value is more than the cash flows, I have impairment, and then I'm going to have to calculate what the loss on impairment is as the difference between the fair value and the book value. So it's a two-step process, okay? So let's go ahead and let's take a look at this one. And King Corporation owns machinery with a book value of $760,000. Okay, there's my book value. It's estimated the machine will generate future cash flows of $700,000. Do I have impairment? Yes, I do, because my cash flows are less than my book value. They tell me what? That the fair value of the machine is $560,000. So if I have a book value of $760,000, right? And they tell me here that the fair value is only what? $560,000. That means I have what? I have an impairment here of $200,000. Okay. Now, when you look at the next question, just to sort of help us remember what we just said, here the corporation owns a machinery with a book value of $570,000 and is estimated that the cash flows will generate cash flows of $600,000. Cash flows are more than the book value. I stop there. I don't have to go into step 2. My impairment is 0. Okay? Okay, good. Let's take a look. Okay, good. Let's take a look at this number 12 we are on, okay, Ramos Company, and they purchased machinery that was installed and ready for use, and they want the depreciation expense using double declining balance. Okay, now double declining balance is going to be double the straight line. So the first thing I like to do with these questions is figure out, well, what is going to be my double the straight line, right? And in this class, I'll pretty much keep it with double declining balance. There's triple declining. There's 150% declining. We'll stick with double. Okay, so I sit here and I have 1 divided by the 5 years. That's 20% per year. And then I go ahead and I multiply that by 2. That's 40% on my double declining balance. Now they tell me that the cost is $320,000. Okay, they give me the salvage value. Don't really care about it in the calculations. I'm not going to depreciate below salvage value, but I don't use it in my calculation for double declining balance. So I've got my percentage. I've got my base, 230. 230 times 40%. Right? Means that in that first year in 2020, now they asked me for 2021, but I have to calculate the first year to be able to get to the second year in a declining balance calculation. 230 times 40% is going to give me in that first year $92,000. That's year 1. Okay. So I take that, what? I take that $92,000 from year 1. I subtract that off of the, when I'm saying year 1, the 2020 depreciation. I take that from the beginning balance when they bought it of $230. That gives me $138,000. That now becomes the balance that carries forward for my year 2 declining balance depreciation. Again, I multiply that by 0.40. I say year 2. That's the year they're asking me for here. 2021 is the second year, and that gives me $55,200. Okay, not too tough. All right, good. Now we come over and we take a look at number 13, Endeavor Company, and they're going to sit here and use the activity method for the depreciation. So activity method, like straight line, takes whatever you paid for the asset, $1,200,000, subtracts the salvage value, which is $60,000. So we get that depreciable base similarly to how we would with straight line, and that gives me now a depreciation base of $1,140,000. Now, instead of dividing it by the years, and guys, don't get freaked out if the question gives you the useful life in years, even if we're asking you for the activity method, then of course we'd also have to give you the activity, but they could give you the years just to mess you up. So it's 1,400,000 divided by what? The 10,000 at total hours they think they'll get out of this. And so we're thinking that this thing's going to depreciate at $114 per hour of use. Now they asked me what the depreciation should be, and if I didn't use the asset at all, I might not have any depreciation on that. But here they told me that I used it for 1,100 hours. So 114 times the 1,100 hours they used it in the current year gives me 125,400, which is the answer to this question. Okay, if they had used it some other amount of time, next year they only use it, say 1,000 hours, then I multiply the 114 by the 1,000 and so on. Okay, okay, good. Let's go ahead with number 14. Okay, which of the following costs of goodwill should be amortized? Stop. I don't have to read the rest of this. We don't amortize goodwill. Goodwill, we do what? We don't create goodwill. We have to acquire goodwill from another entity. We acquire goodwill from another entity when we pay more than the what? Fair market value of the net assets of that company. Okay, so we acquire goodwill. You don't develop goodwill. And then once you have goodwill, you don't amortize it because we don't know what its useful life is going to be. However, we do evaluate it at least annually for impairment. Those are the rules. So if they're asking me what should I amortize for goodwill, I save myself a lot of time on that question. That's a no-no. You do not amortize goodwill. Okay? Okay, good. Number 15, which of the following legal fees should be capitalized? Legal fee to obtain the copyright, legal fee to successfully defend. Yeah, okay. The rule with what? With developing the technology that goes along with the copyright, expense all that. But when you get to the point now where all you're doing is registering the patent, you're having to defend the patent, you have something of value there, then you can go ahead and start capitalizing. So anything you spend to develop the patent, no. You start incurring legal fees to register it, that sort of thing, then they allow you to start capitalizing. So that's a yes, yes. Okay? Okay, good. Number 16. On January 1st, 2014, Russell Company purchased a copyright for $2,500,000. Now, hang on a second. Now they've purchased a copyright. Any money that you spend, you sit there trying to write a beautiful, melody that the whole world's going to love. Any money you spend to develop that, no. But once you have a copyright and you sell that copyright to somebody else acquires that copyright, the person acquiring the copyright, they can capitalize the cost of that, and the cost of a copyright, okay, does get amortized because they have some very specific rules. I think it's 75 years, the life of the developer plus 75 years or something along those lines, whatever. I would never test you on what's the legal time, that you're allowed to use a copyright. I'll give you the life in the question like we did with this one, so you can calculate whatever the amortization is on that, okay? So in this particular case, Russell Company purchased a copyright for $2,500,000, having a useful life of 16 years. Well, look, I know I'm going to be able to capitalize that, and I know I'm going to amortize that over 16 years. So I take what? I take the $2,500,000. There's no salvage value here. I divide it by the 16 years. $2,500,000 divided by the 16 years. Okay, so we have our $2,500,000 that we paid for this copyright. We're going to divide it by the useful life they told us is 16 years. And when I do that, now I get a per year amortization on this thing of $156,000. Okay. Times 156,000 per year, right? That's my per year. And then I'm going to multiply that by the number of years that I had depreciated up until the time that they had to pay these legal fees, because then I'm going to capitalize that and then amortize that remaining over the remaining useful life. So 250,000 and then it's 156,000 a year, and that's going to be what, all of 14, 15, 16, 17. They didn't have to pay these legal fees until 18. So that means now that they had amortized it for 4 years, 156,000 a year times the 4 years, 156,000 a year times the 4 years gives me 625,000, right? So I'm just going to go over here and I'm going to change this to red just because we've got a bunch of numbers swimming around here. And so I had what, 2,500,000. I depreciated off of that for those 4 years 625,000. So I had a book value at the start of 18 here. I had a book value of 1,875,000. Okay. Now, what am I going to do with that? I have to sit there and I have to go ahead and add the successful legal fees, because I can capitalize those, but then of course I'm going to have to amortize them. So 1,875,000 plus the 375 brings the book value here in 2018 to 2,250,000, and then I have to now amortize that over how many years? So I'll write over here, because again I'm starting to get a bunch of numbers swimming around here. I had 16 years, okay, to start it, 16 years. I amortized it for what? For 4 years. That was times 4 years. Okay, I amortized that times 4 years. I amortized it for 4 years. So that left me, what, 12 years left at the time that I had to pay these legal fees and stuff. So I go ahead and I divide that by 12. 2,250,000 divided by 12 gives me 187,500 that I will take in 2018, and assuming I don't have to pay any more legal fees or anything, and this thing continues to last through the remaining 12 years, I'll take 187,500 each year going forward. Okay? Okay, good. So sometimes, you know, the concepts here are not as difficult as making sure you're keeping track of the patterns as you go through, or the steps and the changes and whatnot as you go through. Okay? Okay, good. Let's take a look at this one. And we have this coal company purchased a patent. Okay, so here we go. We're purchasing a patent. If we're purchasing the patent, I'm going to pick up that number because I know they're going to make me do something with that. At the time of the purchase, the patent was valid for 15 years. However, the patent's useful life was estimated to be 10 years. It is the shorter of the legal life, the valid life in this case, they're calling it, and the useful life. And so the useful life is shorter, so I'm going to pick up that 10 years. On December 31st, the product was permanently withdrawn from the market under the government order because of the potential health hazard in the product. Okay, well, hey, we thought we had a patent that was going to last 10 years, but it looks like, what, after what we used the patent, we got the patent in 15, we were able to use it in 15, 16, 17, and then the government came down at the end of 18 and said, hey, no, forget about it, you can't use it anymore. So what happens? So I went ahead and for at least 3 years anyway, I was amortizing it over that 10 year. So I was using 80,000 per year, okay, times the 3 years, 15, 16, 17 that I used it. Don't worry about 18 yet. So that's what, 240,000 that I was able to amortize this without the government telling me I couldn't use this thing anymore because it's causing a health hazard. Can't make people sick, right? And so I've got what? I've got this $560,000 that was sitting there at the beginning of 18, and then something happened. They discovered a health problem. Can't use it anymore. So what would I do? I write off the entire 560. Whatever was left, I debit loss. I credit the patent for the 560 to write off that remaining book value, and I'm done. Okay, so what is the amount that is charged to income? Well, what's my loss? The charge to income is the loss. So I would take a $560,000 loss, and we don't start to get into, well, wait a minute, how much of that is amortization expense versus loss on value of the patent? Just take it all and dump it into the loss, okay, at that point in time. Okay, all right, good. Come over, and we've got this Lopez Corporation, and Lopez Corporation incurred $840,000 of research and development costs to develop a product for which a patent was granted. And I started saying, how much should be capitalized for the patent? Don't you dare. The amount that you spend to develop the patent is a research and development expense, right? Okay, but they continue on. The patent was granted, and then legal fees and other costs associated with the registration of the patent totaled $160,000. Well, I know that I'm going to capitalize that $160,000. On March 31st, Lopez paid $350,000 for legal fees for a successful defense. The amount capitalized for the patent through March 31st, 2021, and so I picked up the $160,000, and I'm going to have to pick up what? The successful legal fees of $350,000. Okay, and so you add those two together, that gives me $160,000, and $350,000 gives me what? $510,000. Okay. Looking at this question now, I guess it's okay. This is an okay question because they gave us $510,000, and then all the other amounts were more. My initial concern there a second ago was, well, wait a minute, do they want the amount that was still on the balance sheet at that point? Because I would have amortized some of this $160,000. Although they didn't give me a life on it either, so that also helped me. The $160,000 would have been amortized, so I'm like, well, the amount that would have been amortized up till they paid the legal fees, then I add that, and then I'd have to amortize that. And do they want the amount, at March 31st? But the thing is, since they don't give you an amount that's less, you don't have to worry about it. They just wanted to see, do you know the amounts that would have hit the intangible asset patent for this thing over the life of the thing at any point in time, debited it, and not considering any amortization that would have been taken on that. Without considering amortization, they probably should have said that. What would be the amount that would have been capitalized? Okay, let's go ahead and take a look now at this next one now, number 19. Okay, so when we look at this one now, we say which of the following does not allow a company to exclude a short-term obligation from current liabilities? In other words, put it down into the long-term section. Okay, now let's review the rules there. If I refinance that, and I refinance that from a short-term to a long-term basis. So I had a note that was going to come due in, say, a couple months into the start of the new year, but I go ahead and I refinance that, and I refinance it to, say, a 5-year debt. Then as long as I have executed that refinancing before I issue the financial statements, under US GAAP, they allow me to go ahead and push that down to the non-current section because the refinancing was executed before I issue the financial statements. Okay. Now, what if I haven't had a chance to refinance that before I issue the financial statements? Well, now they say that if you have, the rule is that if you have a contract, they're going to allow you to refinance that. It's a contract that will allow you to refinance, even though you haven't refinanced yet. And that contract exists before the balance sheet date, then you can put that down in the non-current because you have the right to refinance it under the contract anytime you see fit. But that contract has to be in place what? Before the balance sheet date. Okay, the only time we extend beyond the balance sheet date is if we've actually refinanced, and then we're cut off at what? And that one's kind of obvious, the issue of the financial statements. Okay, so if those are the rules, let's go ahead and let's take a look. Which of the following does not allow a company to exclude a short-term obligation? Does not allow a company to exclude a short-term obligation from current liabilities. In other words, does not allow you to put it down to the long-term section. So management indicates that they are going to refinance. Okay, management can indicate all kinds of things, guys. That is the worst possible evidence that they're going to be able to do it. And so A, I shouldn't cross it out. That's the right answer. That will not allow their indications. What are they jumping up and down, waving their hands? What do we mean by that? It's got to be much stronger than that. They either refinanced it before the balance sheet date. They either refinanced it before they issued the financial statements, or they have a contract in place before the balance sheet date. Okay, all right. So they actually refinance. Yeah, actually refinance. Put it down in the long term. The liabilities contractually due more than 1 year after the balance sheet date. Okay, obviously, if it's more than 1 year, it's not current, and so we don't even have to worry about any sort of refinancing opportunities. D, they have a contractual right to defer settlement of the liability for at least 1 year after the balance sheet date. Good, they have a contractual right. Okay, so this one didn't get so much up into did they actually refinance or have a contract before the issuance of the financial statements, before the year end. And so the obvious problem here was, the one where you wouldn't be able to is they indicated. Okay, they got to have contracts and stuff in place essentially. Okay. Okay, let's take a look at this number 20. And we've got the situation where Craig borrowed $700,000 on October 1st, 2020, and is required to pay $720,000. They're going to have to pay that on March 1st of the next year, 2021. Okay. Now, what amount is the note payable on October 1st, 2020, and how much interest should be recognized from the period October 1st to December 31st, 2020. Okay, so we've got two different things they're asking us here, and they're really asking us two amounts at two different dates. One is the note payable right after they signed it on October 1st, 2020. They want to know that. And then they want to know what is the interest. Now, it's helpful to review the journal entries for a note that's structured like this. It doesn't call it a non-interest bearing note, but notice there's no interest rate here. So with a non-interest bearing note, they loan you up front, say in this example, $700,000, okay, but they expect you to pay them back $720 when the note matures on, again, I guess it's March 1st of the next year. So we debit the cash for the cash they give us, okay, just right there. We credit the note payable for the full amount of the note that'll come due next year. And then the difference, okay, sometimes students ask me, I don't understand, where the discount comes from. Well, the difference between the note payable and the cash you get is the discount. So at 10-1, which is the first part of this question, as soon as we signed the note, we would have note payable, just doing the liability section, note payable $720, discount of 20, so the net note payable is $700,000. So you look, and okay, I guess that helped a little bit. We got rid of C there. They pretty much expect we're going to figure out that $700,000. Now, they trick you into some of these other things, trying to make it say, well, since it's no interest bearing, whatever, no, the interest expense is zero, which of course is nonsense. Okay, that's never the case. So let's go ahead and let's take a look at how we would amortize that discount. So since the discount is $20,000 and the note, and be careful guys, count on your fingers, October, November, December, that's 3 months that have gone by, and the note is how long? October, November, December, January, February, don't count March, because it's March 1st. Very easy to make that mistake. So that note is only a 5-month note. They didn't tell me that, but it's a 5-month note of which 3 months have gone by. The first in 2020, which is when they're asking me for the interest expense. So 20,000 times 3/5 is 12,000. Okay, so I would do what? I would debit. Where do I want to squeeze this in? I'll write my journal entry up here, guys. Once I get that 12,000, I would debit interest expense 12,000 and credit the discount 12,000. Okay. Now the question really didn't. So the answer here is what? B. That's the interest expense, right? Now the question didn't ask this, but at 12/31, just to kind of finish the thought here, at 12/31/2020, I'll have what? I'll have and the note payable is still this 720,000. But the discount is now what? It was 20 when I first set it up, when I debited it. I credited up here for 12, so the discount is now 8,000. So now the note payable is what? The net note payable is 712,000. They didn't ask me that in this question, and that wasn't necessary to get that, but I just thought it was worthwhile to see how the value of the note comes up for the amount of interest expense that has accrued, has expired up to that point. And of course, by the time you go to pay that off, the discount would be 0, the full note payable 720, debit the note payable 720, credit the cash 720 when you pay back the full amount of the note. Okay, good. Let's take a look at number 21. And we've got this Venable newspaper, sold 6,000 of annual subscriptions at $150 each at June 1st. How much unearned revenue will exist at December 31st? So again, let's go ahead and take a look. And it's 6,000 subscriptions. The subscription is $1.50 each. Okay, so 6,000 times $1.50 means that they sold subscriptions of 900,000. So when they do that, they're going to have a debit to cash of 900,000, a credit to unearned revenue of 900,000. Okay, so now we have unearned. Okay, that's an R. Unearned revenue, and the unearned revenue is this 900,000. All right, okay. Then what happens? Then we go ahead and they tell us that they sold those on June 1st, okay, and they tell us it's an annual subscription. And so what's happened? If you sold them on June 1st for an annual subscription, that means by December 31st, how much has been used up? They've used June, July, August, September, October, November, December. They've used 7 months of that. So I take that 900,000 times what? Times 7/12. 900,000 times 7/12, okay, gives me 525,000 that has been used at this point in time. Okay, so if you've got 525,000 that has been used at this time, you take the you're going to debit. Yes, I always run out of room here, but let me go ahead and steal some of this here. This is continuing on here. Okay, you debit the unearned for the 525,000 that's been earned, and you credit revenue. Don't call it earned revenue, guys, because if you just call it revenue, everybody in the world understands that you mean that that's earned. So we debit unearned, we credit the revenue, 525,000, because that's what's been earned. And just using the T account up here, okay, 900,000 minus the 525 that's been earned means there's still a balance left in here. Let me just put my balance down here of what? 375,000. That's the amount that's still unearned. Okay, choice B. All right. Okay, good. Well, let's go ahead now, and we're on 22. I know I used up some of the room from 22 for this, for 21 here. So we're on 22 now. Okay. So let's just take a look at this question. I'm trying to highlight it. Okay, good. We're on that one. Okay. So on February 10th, 2021, after issuance of its financial statements, okay, so we've already issued the financial statements, Higgins Company entered into a financing agreement with Cleveland Bank, allowing Higgins Company to borrow up to $8 million anytime through December 2023. Okay, now this contract, they're telling us it's after the issuance of the financial statements. If it's after the issuance of the financial statements, it's clearly after the year end, and the only time that we're able to move a current item into the long-term section is when what? Is when we have either refinanced it before the year end is obvious, before the issuance of the financial statements, or we have to have what? We have to have had a contract in place to refinance it before the date of the financial statements, December 31st, let's say year end. So this contract to me is suspect right off the gate because it was a contract. It wasn't the actual refinance. It was a contract that was in place, what? You know, after the year end, obviously, and even after the issue of the financial statements. So this thing's off the chart. This is not going to help us to categorize this as a non-current liability. Okay, into a refinancing agreement with Cleveland Bank, allowing Higgins Company to borrow up to $8 million at any time through 2023. So it goes to the future. Amounts borrowed under the agreement bear interest at 12% above the bank's prime rate and mature 2 years from the date of the loan. Higgins Company presently has $3 million of notes payable with Star National Bank maturing in March 15, 2021. So at the end of the year, those were current liabilities, right? And so far, I haven't seen anything in this question that they did, action that they took either before, by the balance sheet date or before the issuance of the financial statements. I see no actions that are going to allow them to carry that as non-current. The company intends to borrow $5 million under the agreement with Cleveland to liquidate the note payable to Star National Bank. Fine, but they hadn't got that contract before year end, and they hadn't executed any refinance before they issued the financial statements. So the company intends to borrow $5 million under the agreement with Cleveland and liquidate the note payable to Star National Bank. The agreement with Cleveland also requires Higgins to maintain blah, 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 blah. From the above information, at December 31st, what should we show as its short-term debt? The $3 million. Okay, they ran us through all kinds of things that had gone on with this, trying to trick us into saying, well, and of course, you wouldn't record amounts as payables before you even incurred them. They hadn't even borrowed any of the money yet on this, so that's obviously not right. C and D. So your choices would have been between B and A, and as I said, there was nothing they did. They either had to refinance it before they issued the financial statements, or they would have had to have a contract in place before the balance sheet date. They had neither, so they have to keep that all as a short term. Okay? Okay, good. Let's go ahead and let's take a look at XCOM. Okay, manufacturers. And they manufacture these home electronic systems. The company provides a 1-year warranty for all products sold. The company estimates that the warranty cost is $300 per unit and report a liability for estimated warranty cost of $10.4. Okay, and that 10.4 is at the beginning of this year. If during the year the company sold 60,000 units for a total of $324 million and paid warranty claims of $12 million on current and prior year sales, what amount of liability should the company report at the balance sheet date at the end of the current year? Okay, now when I look at a problem like this, I say, well, they're basically asking me to analyze the warranty liability. Okay, and when they ask me to analyze an account, I have to take the information they give me. What is the beginning balance? What are the adds? Okay, and for this account, the add is what? Is the actual warranty expense for the period based on sales. Subtracts are what was what? Paid out on warranties, paid out on the liability, right? Somebody give us somebody a warranty, and then you're gonna have to pay, some money to fix their stuff. That's a payout on that liability. And then the ending balance, okay, so I have to come down here to this question. That ending balance is, the question, the answer to this question, it'll give us the right answer. Okay? Okay, good. So now you turn a question that could have been potentially kind of hard into a pretty easy fill in the blank. Okay? So they tell me that the warranty cost is $300 per unit sold, a liability of estimated warranty of $10.4 million at the beginning of the year. Thank you. I'm going to go ahead, 10.4. I'm going to write it in as 10,400,000, just because I want to make sure that I don't, make some mistake with this, something silly like a decimal point somewhere. So 10,400,000. And of course, the pen's going to make me suffer all the way through writing that. 10,400,000. Now, I have to figure out the warranty expense for the period, and they tell me that the warranty costs $300 per unit sold, and they tell me that they sold 60,000 units. So 60,000 units times the $300 per unit means that they have here, if I'm doing my math, please tell me I wrote it down somewhere. Okay, 300 times 60,000 gives me 18 million. Okay, so what are they going to do? They're going to debit, because we match it with our sales, warranty expense 18 million. And they're going to credit the liability. For 18 million. Ugh. Okay, so when they go ahead and they credit that liability for 18 million, and of course my numbers don't line up. They add up, but they don't line up. We're going to sit here, and I'm going to have to put my subtract down a little lower. Although subtotal isn't really necessary here, to be honest with you, because they're asking me the ending balance. Sometimes I use a subtotal if I'm going to have to work my way up to the beginning balance or something, so I don't think I need a subtotal. But it's what? It's going to be the subtotal. Okay, I'll go ahead, I'll write it in. Subtotal, I think, is going to be 28,400,000, right? Am I doing my math right? 28,400,000. And then they tell me that they did what? That they paid claims of 12 million. So if they paid claims of 12 million, just to make sure we're clear on that journal entry, they would have debited, to decrease a liability, you debit it, right? They would have debited the liability, the warranty liability, right? That account right there. They would have debited it for 12 and credited the cash or whatever, parts, whatever they're having to pay to fix this stuff. $12 million, I'll just assume it's a cash, $12 million that they're crediting. And so you end up with what? 28.4 minus what? Minus 12 million should give me the correct answer to this question, which is going to be what? 16,400,000. Okay. All right, good. So that problem's not too bad. Okay, good. Number 24. We're getting there, guys. We're going to do these last couple multiple choice questions, and then we're going to get a chance to work a couple of the sort of full-blown type questions. So let's take a look, though. Number 24. A company offers a cash rebate of $1 on each $4 package of light bulbs sold in 2021. Historically, 10% of the customers mail in the rebate form, right? And I think I said I'm one of those people that never take the rebate. I buy $4, I spend $4. All I got to do is send in this stupid piece of paper, and they'll send me $1 back, and I never do it. It's like throwing $1 away in the garbage. Okay, so what happens? They tell us that during 2021. 3,750,000 packages of light bulbs were sold, and 200,000 $1 rebates were actually mailed out to customers. So the person sent in the rebate and they had to send them back $1 back, right? Okay. So what is the rebate expense and liability respectively shown on the 2021 financial statements dated December 31st. So what happens? They're sitting there and they have the amount of these rebates that they think are going to be redeemed, which is what? 3,750,000 packages times 0.1 equals 375,000 rebates they think they'll have to give. It's $1 each. Okay, so I really have to do the math there. I think I can figure out the 375,000 times $1 is $375,000. So what are they going to do? They're going to debit this rebate expense, whatever, 375,000, and credit rebate liability. $375,000. Okay, that journal entry right there. Kind of hard to see it there. That other stuff in the way, right? Okay, good. So they go ahead and they set up the liability. Now what happens? Over the course of the year, $200,000 rebates, $200,000 worth of rebates are mailed out. So they're going to get to, it's driving me nuts with having the amount of room to write all this. They go ahead and they're going to debit rebate liability, $200,000, and credit cash, right? Because they're sending back people money. Not me, because I always throw my thing away, but they're going to go ahead and do that. So once they do that, now the liability, just to use a T account to figure it out, liability originally had what? 375, and then we went ahead and debited it for what? 200. So it still has what? 175 left in there, if I'm doing the math in my head correctly. Okay, and so we have what? We have liability on the financial statements dated December 31st. What amount of rebate expense and liability? Expense is what? 375. Liability, as we just shown, was 175. Answer B. Okay. All right, good. Let's take a look at number 25. And again, no room. So where do I want to write it? Okay, just so irritating. Okay, there's no room to write some of these, but let's just go ahead and let's do our best. Okay, so oil company buys an oil rig for $3 million on January 1st, 2021. Okay, so they're going to debit the oil rig, the asset oil rig, for, what do they say? $3 million. Squeeze that in. Let's see if I can give myself a little more room. I don't know how much it's going to help, but they go ahead and they do that for $3 million. Okay, and they credit cash. I'm not going to show you cash here. Okay, then what? The life of the rig is 10 years, and the expected cost to dismantle the rig at the end of the 10 years is $600,000 with a present value of $231. Okay, so let's go ahead. I'm just going to write the journal entry here, guys. I don't have anywhere else to write it. We're going to debit what? We're going to debit the oil rig for the present value. We use present value here, $231,330. And we're going to credit the asset retirement obligation account, $231,330. Okay, so now the ARO is $231,300. Okay, good. And you got to do this, okay? Under the US GAAP rules, they make you look at, hey, you got the government, the EPA, whatever, looking down on you, saying, hey, you're going to clean that up. You're not going to leave that mess there. And so GAAP says, well, that's the definition of a liability. You're going to have to start accruing that liability, okay? Now, they tell me that the appropriate interest rate is 10%. So I'm going to have to accrue that up, taking that interest expense each year into the asset retirement obligation account till it finally will be amortized up to the future value of what they told us is $600,000 here. And I have to depreciate the asset. So I forgot to post my $231,330. Okay. Let's rewrite this. Move this over a little bit. I need the debits here. Debit sign to be a little bigger. The original $3 million plus the $231,330. Okay. Okay, good. So I went ahead and I just posted that journal entry, right? Okay, so now what? What expense should be recorded for 12/31 as a result of the what expense should be recorded for 21 as a result of these events? And they give me depreciation expense I have to worry about. They give me interest expense I have to worry about. Now, the depreciation is going to be based on this entire $3,231,330 that's sitting there in that asset account. They told me what? It's 10 years. I divide that by the 10 years now, 3,231,330 divided by 10 years gives me $323,130. 133. Okay, so I look at my choices and, you know, thank you, God, I could stop right there if I wanted to, because it's the only one that has the right depreciation amount. But then I have to get the interest, and the interest is based on the asset retirement obligation liability. They tell me the interest rate on that is 10%. So 231,300 times 0.10, whatever, you don't need the O there, gives me what, 23,133, which I knew that was the answer anyway, because once I got the first part of that, they didn't have anything else that had other amounts for depreciation, or the same amount for depreciation, that would have made it a little more confusing, frankly, or a little tougher question. Okay, all right, good. We're getting there. Okay, let's go ahead and take a look now at a couple of examples of the full-blown type problem that I'll give you. That problem will be worth 20 points. There will be more than one element to the problem. If you get one of the elements wrong, I'll subtract some points from you. So you get points for what you put down correctly. Okay, so you can get partial credit on these, but they constitute more of a full-blown problem, kind of like a simulation type problem that you might see on the CPA exam. And so for those, you know, I'd give a total of 20 points. But again, you can get, just like on the CPA exam, you can get partial credit if you don't get everything perfect on the question, okay? So let's just go ahead and take a look at these. And the two areas potentially I will give you the full-blown problem on is going to be note payable, or is going to be non-monetary transactions. So I gave you an example of each. Could be either. I'm not going to give you a full-blown problem on any other of the subject matter. Yes, multiple choice questions, like the ones we saw here, like the ones you see in your practice midterm per chapter, but for the full-blown problem, it's going to be either note payable or non-commercial, not non-commercial, but non-monetary transaction. Okay? Okay, good. So we take a look at this problem here. On November 30th, a company borrowed $300,000, 12-month, zero interest note for $330,000. So they got $300,000. They're going to have to pay back $330,000. And I basically ask you for the journal entry at the time of the borrowing, and I ask you for the journal entry at the end of the year, and then I ask you what would the balance sheet look like as a result of this. Okay, so we come down and we start to take a look here at the solution. Okay, and the journal entry is what? You got $300,000, so you debit $300,000. You got the note payable for $330,000, and so now I'm going to have to do what? The difference between the amount of the note payable, I was trying to change the color there, between the amount of the note payable and the cash that you got is the discount on the note payable, right? Okay, just like we saw in that multiple choice question we were looking at before. Now, to calculate the interest expense, we have to do what? We have to sit there. That's what they asked us to do next, at December 31st. What is the interest expense? We have to amortize some of that discount. So since they borrowed the money on, we'll just say September 30th, I don't have to say it, there it is, September 1st, it's all of October, all of November, all of December, so we got to accrue 3 months of interest. The interest is based off of the fact that, hey, we're going to have to pay them back $30,000. We only got $300,000. You pay somebody $330,000 back. That $30,000 difference is the interest. So we multiply that by the, it's a 12-month note. Okay, don't always use 12-month year. You got to look at the term of the note. Okay, so it was a 12-month note. I think that other one we're looking at, remember, was a 5-month note. Here it's a 12-month note. So I debit interest expense. I credit the discount. Okay, so now when I prepare the financial statements at 12/31, and just to make sure we were kind of following what was happening with the discount originally had been debited for 30, right? Then we went ahead and according to our journal entry up here that we calculated, we credited the discount for 7.5. So that means the discount still has a balance in it, what, of 22,005. I'm just writing that underneath the debit there. It's a debit balance of 22,500. So the note payable, we had originally credited it for 330. We did what? We had amortized the discount down to 22,500. That's 307,500 left on the note payable, net note payable. It's coming up by the amount of interest that it has accrued, so that by the time this thing is finally mature, the net note payable will be 330. The discount will be 0. We go ahead and we do what? We debit the note payable, 330. We credit the cash and we pay them back. Okay? All right, good. Now you come over and you take a look at this next question. Okay? And so we're sitting here, we've got this Lane company has a machine that cost $850,000 on March 20th, 2017. Okay, so they, I guess they're telling us they had bought it for that much on that date. Okay, they says they have a machine, they bought it that day. Okay, the old machine has an estimated life of 10 years and a salvage value of $50,000. On March 23rd, 2021, the old machine is exchanged for a new machine with a fair value of $545. Okay, so they used the old machine for a while, got the new machine, and did what? Went ahead and exchanged that machine for the old one for the new one. The exchange lacked commercial substance. Okay, lacked commercial substance. What are we going to do? Always take gains. What are we going to do? Always take losses, gains. We have to think about if we what? If we receive the cash, we can take a partial gain. If we paid the cash, we won't take a gain unless the cash constitutes 25% or more of the total consideration, right? Lane receives $60,000. Okay, here we go. So since they received $60,000, we're sitting here and saying, well, I know I'm going to have some gain on this thing, okay? Assume the last fiscal period ended December 31st, 2020. Well, that would make it a calendar year period, but okay. And the straight line depreciation is used, okay? All right, so I'm just going to come down. They say show the calculation of the amount of gain or loss to be recognized by Lane Company. Prepare the journal entry. Now, I might ask you to prepare the journal entry. I'm not too hopped up on asking you to show me calculations in e-learning. It's, not something I care about. But I will want you to potentially tell me what's the depreciation expense, what's the thing, and I'll ask you different things, okay? So let's just go ahead, though, and see. Now, the old machine, they got for $850. Now, we were depreciating that, and we were depreciating that at straight line, okay? And they told me that it had a salvage value of $50, okay? So we're kind of bringing in some other factors. It's not just asking you about non-monetary transaction. You had to know something about your depreciation here too, but nothing earth-shattering. 850,000 minus 50,000 gives me a depreciable base of 800,000. They told me they were depreciating it over what? Where is the 10 years? Okay, they're depreciating it over 10 years. And so we take that divided by the 10 years. Gives me 80,000 per year. Okay. Now what happens? They bought the machine in March. They bought the machine on towards the end of March, and I hate problems. They put in March 20th, and they make you start wondering about those 10 days. We'll just count that as all of March. Okay. So what happens? They didn't depreciate it the first quarter because they didn't have it yet. It's the last 3 quarters of the year in 2017, and then they continued to depreciate it, what? For 18, 19, 20, and 21. They depreciated for those 4 years because they finally got rid of it towards the end of 21. So if it's 4 years, all of 18, all of 19, all of 20, all of 21, and then a quarter of the first year, that means that they depreciated it for 4 3/4 years, because that first year, 2017, they didn't buy it until late in March. So I take the 4 3/4 times the 80,000. They would have depreciated it down at that point to what? To this 300 and, well, they would have taken depreciation at 380, and they would have depreciated it down to this 470. Okay, so they've gone ahead and they've depreciated it down. Now, I know I'm going to take some gain on this because I had cash received, and I will take a gain that's proportionate to the amount of cash that I received, unless the amount is 25% or more of the cash and 25% or more of the fair value, and then I'll take the entire gain. But we'll get to that. Okay, so what is the gain? Well, to figure out the gain, I have to get between the book value and the fair value. But what's the fair value? I just calculated the book value at 470, but what's the fair value? Well, look, we assume that nobody is desperate. You know, I got to sell this thing as quickly as possible because I need to buy a Christmas present, okay? Nobody is desperate. We assume in accounting that everybody is basically going to do this in an orderly fashion, okay? So it tells me that on December 31st, 2020, the old machine is exchanged for a new machine with a fair value of 540. So I'm going to get the new machine, 540, and they also are letting them get 60,000 cash. They're going to give me a new machine and cash of 60,000. And I'm giving them the old machine. Well, that's telling you that the old machine must have value of 600,000. Otherwise, no crazy company out there would give me a machine that has a fair value of 540 and cash of 60, take away my old machine. They're not crazy. They're saying, okay, good, fair value for fair value. I gave them a machine that has fair value of 540. I gave them some cash. I got a machine back. That machine that I'm giving to this company must have what? Must have fair value of 600,000. Okay, so that's what they do there. They're telling you, hey, the fair value, since they gave you a machine worth 540 and they gave you 60,000 in cash, that's telling you the old machine has fair value of 6. So if it has a book value of 4 and a fair value of 6, that means there's a total implied gain there. Okay, I'm going to change the color again. I think I'm going to change the color. There's a total implied gain there of what? Of 130. But should I take that entire gain? And I'm only going to take the entire gain again if the cash constitutes 25% or more of the total consideration. So they put the cash, 60,000 in the numerator. They put the what? The cash plus the fair value of the machine that I got, the total fair value of the transaction. That's only constituting 10%. That's well below our 25% threshold, so we should do what? We should only take 13,000 of that gain, okay? Now, they ask them to catch up their depreciation there, okay, because they hadn't presumably yet taken that last year's depreciation entry, okay? I probably won't get too worried about asking you about that, but you got to catch up your depreciation. And then we can go ahead and put together the full journal entry, okay? And I will definitely, assuming I ask you something about non-monetary transaction, I would definitely expect you to be able to put together the journal entry based on a set of facts like that, okay? But let's go ahead and let's take a look, and I'm going to number this journal entry in a way that I think you would put it together, taking the easiest things first, the harder thing, do that last, okay? So first thing to me that's easy is go ahead and take that old machinery off the books for whatever you paid for it. 150, right? You paid, I mean 850. You paid 850 for it. So the first thing, number one here that you do is you go ahead and credit the machine to take that off the books, okay? Then what? Then you go ahead and you get rid of the accumulated depreciation, which we had calculated up there. Get rid of that. You get rid of the old machine, take off its original cost, take off its accumulated depreciation to take it off the books. Okay. The third thing that I think is easy here is the cash. Okay. You know you got 60,000 cash. You know you got to debit cash. You know you got to credit a gain because we just calculated that gain right there. So I think the gain would probably be the next easiest. And then the hardest, or the last easiest, is number 5 here, that I've numbered 5, which is what are you going to bring the new machine on at? Now, again, I keep saying, hey, you bring the new asset on at the book value of the asset that you surrendered, plus any gain or minus any loss. Okay, now this is one, and I use that rule because it works 100% of the time, but this is a case where you got to think through it a little more, okay, than just the words that I just said. Because here you say, well, look, the book value of the old machine was $470, right? Okay, so book value of old machine was $470. But you stop, and this is where you have to look at the rule a little bit differently. I turned some of that machine into cash. So really the net book value, what I gave up, because I took some cash back, I have to subtract the cash. So the net book value of what I gave up is $470 minus the 60,000. Of course, I can write that down, is 410,000. So net book value, what I gave up, because I gave up an asset worth 470, but I took back an asset of cash of 60. Net, I gave up only 410. And then you bring in, now you go back to the rule that really works all the time, and you don't have to sit there, because I notice they say sometimes they tell you to do this, sometimes they tell you to do that. Do the same thing every time. Book value of assets that were surrendered plus any gain or minus any loss that's recognized. And then you just have to kind of look at this a little bit. Well, when cash starts coming in, what's the net book value of the asset I surrendered, right? And we've got what? We've got 423,000, which is number 5 here. You could have plugged it, if you will, backed into it, I guess, by knowing 1, 2, 3, 4, which was pretty easy, or you could do it like this. And I keep pushing this way of doing it because I could give you a multiple choice question where I don't give you, I don't ask you for the whole journal entry. I don't want to see you have to sit there and put together a whole journal entry just to answer the question. So just remember, book value of assets surrendered plus any gain or minus any loss. Okay? All right, that's a lot of work. Good work, guys. I think we got through that pretty good. I will post up, assuming Word doesn't crash the file when I go to save it. I will post up this marked up version. Okay, so it'll be there. Maybe you've already seen it. And of course, the recording is there. You've seen that. We've talked about the exam and the instructions for the exam. Make sure you're paying attention that the exam is going to open Sunday night, or Sunday, I should say, the 14th at 12 a.m. That's in the morning, okay? And it'll stay there. 12 a.m. is early when the wolves are wandering, okay? Don't be outside at that time, okay? 12 a.m. it'll open, and it stays open all the way until 11:59 on Saturday, February 20th, okay? So make sure that you're keeping track of that and taking the exam within that window of time. You're going to give you 3 hours to work it. Plenty of time to work through these, okay? All right, guys, and again, look at the instruction I've given you also in e-learning on that if you want to read through that. Okay? All right, guys, thanks. Have a good rest of the day. Good luck on your exam, and we'll talk soon.